So once we enter an option, then we have trade management rules we use to manage the trade. And the first trade management rule is we exit losing trades quickly before they turn into large losses. And rule number 2 is we don't exit winning trades with a small gain. And that's just basic portfolio management. You want to cut your losses short, but you want to ride your winning trades in order for those winning trades to profit. And if you have a portfolio of options, if you have 10 options and you have 2 big winners, that could make your portfolio profitable. So we use simple portfolio management of exiting losing trades quickly and then holding on to winning trades. We also have a trade management rule that we use options to protect profits with winning trades, and I'll show you how we do that here with our option spread presentation coming up here. So if we have a profit in a call option, then we want to protect that profit by creating a spread trade. We also roll over expiring options to reduce the cost basis and risk of the new option, and that allows us to compound our returns. So if the stock is still on a prime trade select buy signal at expiration, we'll roll it over, and that will reduce the cost basis of the new option. We also like to limit the size of our trades to 10% or less of the total portfolio, thereby mitigating losses if you incur a big loss with one of your trades. So if you have a portfolio and you have 30% of your portfolio in one trade and it has a large loss, that's gonna create a big loss for your portfolio. So we try to limit the size of the trades to 10% or less of the total portfolio. And another trade management rule we use is we like to use several different types of trading strategies for diversification. Right now, as I mentioned before, we're using the option purchase, the option debit spread, and the profit guard spread trades in our trading during volatile markets. So if you use several different types of strategies in your portfolio, that you'll be more diversified. Okay, let's look at exiting losing trades quickly before they turn into large losses. And what I did was I just took our closed trades over a recent period, and these are our brokerage account profit loss reports here. And this column lists the profit or the loss on the option that we incurred. And over this time period, we exited the losing trades quickly because our average losing trade was 14%. So we like to exit losing option trades before we get to about a 20% loss. That way we save our capital and we just move on to the next opportunity. So we like to limit our losses. In this example with these closed trades, the average losing trade was 14%. And then we don't like to exit winning trades with a small gain, and the average winning trade in this time period for our closed trades was 136%. So average losing trade was 14%, average winning trade was 136%. So we were able to cut our losses quickly and hold on to our winning trades. And in this example, we only need to win on about 1 out of 8 trades in order to have a profitable portfolio. So that would allow us to, of course, maintain our 3-to-1 profit to loss ratio. So the reason you want to exit losing trades quickly is it's hard to make up large losing trades. So if you incur a 20% loss, it takes a 25% return on the next trade to break even. If you incur a 50% loss, it takes a 100% return on your next trade to break even. And how many 100% winners have you had lately? So the goal is not to take large losing trades. So if you limit your losses to 20%, you can survive and just move on to the next profit opportunity. And we also, as I mentioned, roll over expiring options to reduce the cost basis and risk of the new option, and that allows us to compound our returns. So we'll roll over at expiration if the stock is still on a buy signal. And I'll show you a few examples here of rollovers. And when you roll over, it reduces risk and allows you to compound your returns. And we're talking about rolling over our profits now from the trade that we closed out into the new trade. So if you roll over those profits, you can reduce the cost basis and risk of that new trade. So here's a few examples of closed out trades. Here's one for the utility ETF. We closed out of the 40 strike call with a $200 profit, and we rolled into the 42 strike call, and we had a $216 profit on the closeout of the 40 call. So the cost of the new call, the September 42 call, was $690. So we rolled over our profits, and that reduced the cost basis of the new call to $474. So in this case, we reduced our risk by 31%. So we're going to get a higher return on the new option. Here's another example. This is for the QQQ. We closed out the 95 call with a $509 profit. The cost of the new option, let's see here, I have the wrong brokerage statement here, but in this example, we were able to reduce the cost basis of the new option by $319 down to $1,015 instead of $1,300. So when you roll over options, that allows us to reduce our risk. So we have an option advisory service where we make recommendations for call option purchases. We send out email alerts to members with instructions whenever we have a new option trade recommendation, or if we're exiting a existing trade. And we maintain a portfolio of option trade recommendations, and then those prices are updated regularly so that the members can see how each trade recommendation is performing. And we also maintain a closed trade record of all the closed trades so that we have a full accounting of all the trade recommendations that we make. And members of the option advisory service also get access to the 6 option calculators that are available that allow you to calculate the profit loss potential for a trade before you take the trade. So here's our current portfolio of options, and we have $103,000 open trade profit and an average return of 213% in our option portfolio. This column lists the options that we own, our entry price, and then the current price, and then the profit and percent return. So average return of 213%. And you can see we roll over profitable trades if the stock is still on a buy signal. So on a lot of these, we've reduced the cost basis to 0 or less than 0. So you can see these trades right here. We've reduced our cost basis to 0. So if you'd like to get more information on our option advisory service, you can call this 800 number or log on to chuckhughesic.com, and then if you click the trade results link, it'll show you the current trade results for the various portfolios.